Picture this. You're on TradingView 10 minutes before New York Open. ES is grinding just under yesterday's high, NQ already wicked both sides of the overnight range, and your favourite Forex pair is sitting inside a clean demand zone you marked last night. Position size is set. Stop loss is ready. You literally wrote in your journal this morning. Risk 1R, follow the plan. No moving stops, no adding, no revenge trading. And then somehow, you become a completely different person. You imagine the green P&L, the Discord screenshot, the feeling of finally being a real trader. Dopamine is already paying you for a trade you haven't even taken. At the same time, your stomach remembers last week's drawdown. Cortisol creeps in. Your heart rate picks up. Every tiny wick looks like a threat. You tell yourself you'll be disciplined, but your mouse quietly bumps size from 1% to 3%, just this once. To feel safer, you drag the stop loss tighter than your tested rules. Price finally taps your level. You hesitate for half a second, then hit buy late, at a worse price, with oversized risk and a stop that's now sitting right where liquidity lives. The next candlestick taps your stop to the pip, flicks you out, and then runs in your original direction without you. Red P&L, spike of shame. That familiar thought, why do I keep doing this to myself? This video is about that exact question, not the fake reason you tell yourself. I just got emotional. I was stupid. The market is manipulated. But the real reason you keep sabotaging your own trading success, even when you know better. Because here's the brutal truth. Your biggest enemy is not ES, NQ Gold, USD or Bitcoin. It's not algos, market makers or Twitter. It's the part of your own brain that thinks it is protecting you, while it slowly destroys your account. If you've read Mark Douglas, The Disciplined Trader, and Trading in the Zone, you already know his core idea. Markets are a probabilistic environment. Any single trade is just one event in a random distribution of wins and losses. You don't need to know what will happen next to make money. You only need a real edge, plus the discipline to execute it over a large sample of trades. But that's not how your brain is wired to see it. Your brain doesn't see 1 of 200 trades in my data set. It sees this trade right now is a referendum on me as a trader. So instead of trading probabilities, you start trading your identity. If this trade wins, you feel smart, talented, finally on the right path. If it loses, it feels like proof that you're a fraud, that you'll never make it. That identity pressure is rocket fuel for self-sabotage. Brett Steenbarger talks about this in his work on trading performance. Most traders think their main job is to control emotions. In reality, the deeper issue is the process you build around your trading, how you adapt, how you review, how you manage your energy and attention each day. When the only scoreboard you look at is today's P&L, you create massive performance anxiety. You're no longer playing a long-term statistical game, you're trying to prove your worth on every single candlestick. Now stack the neuroscience on top. Each green tick in your favour is a tiny dopamine hit. Every red candle against you spikes cortisol and adrenaline. Classic fight or flight chemistry. Your breathing gets shallow, your field of vision narrows, you zoom into the 1-minute chart, desperately looking for certainty that doesn't exist. In that state, your brain doesn't care about your long-term edge. It only cares about getting out of pain and back into pleasure as fast as possible. That's the real engine behind the classic trading sabotage patterns. You hesitate at clean entries because you're trying to avoid the pain of being wrong, so you get in late at the worst price. You move your stop loss just this once because you can't emotionally tolerate locking in a loss, so you transform a planned 1R loss into a 3R disaster. You take random FOMO trades in the middle of nowhere because you can't stand watching other people catch the move without you. All of that is your nervous system trying to protect you from short-term emotional discomfort. By burning down your long-term probability curve. Here's the paradox. The behaviours that feel safest in the moment are the exact behaviours that guarantee you stay stuck. The best trades usually feel uncomfortable at entry. The cleanest setups often come right after a loss. The more you zoom in and analyse, the worse your decision-making becomes. The tighter you drag your stop for better R, the more you place it exactly where the market needs liquidity before moving in your direction. So why doesn't this change even after you've read the books and promised yourself you'll be disciplined tomorrow? Because information doesn't rewire identity. If deep down you still believe you are the kind of person who blows up, who can't follow rules, who always messes up the big moves, your brain will keep pulling you back to that familiar story. Sabotage isn't random. It's your mind trying to drag your results back to the level of your self-image. If your technical edge is built for a professional, but your identity is still stuck as the wrecked retail gambler, your behaviour will quietly sabotage any improvement in your strategy. To see how this plays out in real life, let me introduce you to Marcus. Marcus is what I'd call the reformed gambler archetype. He blew 3 accounts between the ages of 19 and 24. He started with meme coins and crypto leverage, moved to Forex and indices, and then finally landed on futures and stocks. His charts look like half of FinTwit's dream setup. 3 monitors, TradingView on one, DOM and Level 2 on another, order flow and Discord on the third. On paper, he looked dialed in. He woke up an hour before London Open, marked levels on ES, NQ, and 1 or 2 Forex pairs, and wrote scenarios. If price sweeps Asia low and reclaims, I look for longs back into prior day's value. Risk, 1R, stop beyond structure. Risk per trade was set in his platform, sticky note on his monitor. My job is to execute my edge, not to predict the future. And yet twice a month, Marcus would nuke an entire week of progress in one New York session. It always started the same way. A clean setup lost. Price tagged his level, he took the trade, followed his plan, and still got stopped out. Nothing wrong with the trade, just one of the inevitable losers inside the distribution. But his body didn't experience it as one of many trades. His body experienced it as, here we go again, you always lose. Cortisol hit, shoulders tensed, inner dialogue flipped. I knew I shouldn't have taken that. I'm such an idiot. I can't lose again today. If I just get one good trade, I'll call it. Next setup appears. He sees it and freezes. Entry hesitation paralysis. What if this one loses too? What if this starts another drawdown? What if everyone in the Discord nails it and he doesn't? He stares, waiting for confirmation that never comes. The trade triggers, runs perfectly, without him. Now the dopamine flips direction. He feels sick watching the unrealised profit that should have been his print across the screen. That's when the real sabotage kicks in. He smashes a market order at a terrible price just to be in. No clear level, no clean stop. When price wiggles against him, he moves his stop wider because this is just noise. When it finally flushes through, he's down 3R on a setup that wasn't even in his plan. The rest of the session is a blur of overtrading and trying to scalp back tiny wins on the 1-minute chart to feel in control again. By the close, Marcus has turned a normal, acceptable 1R loser into a full-blown tilt day. And walking away from the desk, he hates himself. Not just because of the money, although that hurts, but because once again, he watched himself become the exact trader he promised he'd never be. That right there is trading self-sabotage. When your actions in the heat of the moment directly violate the rules you know would make you profitable over time. So how did Marcus break the loop? First, he stopped pretending it was just emotions. He treated it like a process problem, not a character flaw. He ran a brutal self-review, not of charts, but of his behaviour around the charts. For 2 weeks, he recorded his screen while trading. Then, outside market hours, he watched the footage like a coach watching game tape. Where did his breathing change? When did his posture shift? What thoughts did he say out loud right before he broke a rule? Patterns emerged fast. Rule breaks always followed the same triggers. A stopped-out A-plus setup, a missed move from hesitation, or a big unrealised profit that he watched come back to break even because he got greedy on the exit. Each trigger led to the same cascade, self-attack in his internal dialogue, spike in arousal, narrowing of attention, and then an impulsive trade driven by the need to escape that state. So Marcus built a new process with one goal: interrupt the cascade. He wrote 3 hard rules. 1. After every stopped-out trade that followed his plan, he must step away from the desk for 3 minutes. Stand up, breathe, walk, reset. 2. He capped himself at 3 trades per session. If he hit 3 trades, win or lose, he was done. This killed his ability to spiral into overtrading and revenge loops. 3. He made his maximum daily loss 2R. If he hit minus 2R, the platform blocks new positions. Risk management became survival, not a suggestion. Most traders lose money. The ones who survive respect this line. This is not financial advice. It's Marcus protecting himself from himself. Past patterns don't guarantee future results, but if you don't change your risk, your old patterns will repeat. But rules alone weren't enough. He had to change his identity. From Douglas, he took the idea that your beliefs about yourself create the lens through which you see the market. So Marcus started a different kind of journaling. Instead of only writing about setups, he wrote about the kind of trader he was becoming. I am the trader who takes the loss and moves on. I am the trader who protects capital first. I am the trader who follows my stop, even when it hurts. He was installing a new self-image, risk manager, not gambler. To wire this deeper, he combined it with mental rehearsal. Before each session, he'd close his eyes for a few minutes and imagine specific sabotage scenarios. Getting stopped out on a great setup, missing a perfect move, watching a winner pull back close to break even. But in his rehearsal, instead of tilting, he watched himself execute the new behaviours, taking the planned loss, stepping away, breathing, logging it, and coming back calm. Over a few weeks, something subtle shifted. The same triggers still showed up. The stop-outs, the missed moves, but they didn't hook him as deeply. When he felt the familiar cortisol spike, he recognised it. This is the moment my old self would sabotage. That recognition created a tiny gap between impulse and action. In that gap, he could choose. He also simplified his environment to reduce decision fatigue. Fewer pairs, fewer timeframes. No more 5 indicators stacked on 8 screens. Just his main product, his key levels, price action, and maybe VWAP and volume profile. One clear setup in the direction of his bias. Finally, Marcus shifted his scoreboard. Instead of rating his day by P&L, he rated it by process. How many trades were executed exactly to plan? How many times did he respect his daily stop? How many sessions did he walk away on time instead of trying to make it back? If he had a red day but a 10 out of 10 process, he called it a win. If he had a green day built on FOMO and revenge, he treated it as a dangerous loss. Before long, Marcus's equity curve looked nothing like the roller coaster he used to ride. Still losses, still drawdowns, but no more account-killing sabotage days. Self-sabotage in trading is not a moral failure. It's a mismatch between a brain wired for short-term emotional safety and a game that only rewards long-term, probabilistic thinking. To stop sabotaging yourself, you don't need more indicators, more courses, or more gurus. You need to design processes that protect you from your own fight or flight responses, and you need to upgrade your identity to match the trader your system requires. So next time you're on TradingView, cursor hovering over the order button, remember this: the real battle is not between you and the market. It's between the version of you that needs this trade to prove something, and the version of you that's okay with taking the stop, logging the trade, and waiting for the next clean setup. One of those cells will blow your account up over and over again. The other will quietly, boringly execute an edge, while most traders lose money around you. Which one you feed, every time your stop gets hit, every time you miss a move, every time your brain screams, "Make it back." That's the real reason you either keep sabotaging your trading success or finally stop.